Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Alice Selby. Today we're taking a look at some of the factors that can keep gold glittering over the short and long term. To do that, we're joined by State Street Global Advisors Robin Tsui. Thanks so much for joining me today, Robin.
Thanks for having me.
Gold prices have soared more than 20% over the past 12 months. What has driven that outperformance?
There's been three main factors that's been driving up gold prices. The first factor has been the extremely strong central bank buying led by the emerging market central banks in Asia. And secondly, the rising interest in gold through either the ETFs or the physical market or even the future COMEX has seen a rise in those positions supporting gold price. And thirdly, obviously, the rise in tensions around the world in the Middle East, Russia and Ukraine, that has supported gold price as well.
What factors do you think will drive gold's performance over the next 12 months?
So in the next 12 months, we see a few structural changes that should be positive to gold prices. First of all, the continued strong buying by central banks, led by the emerging market central banks, that will continue to consume about 25% of the annual demand. And secondly, the rise in geopolitical tensions around the world, the spike in market risk volatility that we expect in the second half will continue to provide very strong support to gold price in the second half this year.
Okay, and over the long term, like the much longer term, are there any factors that you could see gold trading higher?
Yes, the first one will be the central banks, because as central banks continue to ramp up their exposure to gold, that's going to be quite a long-term story. And secondly, just the need for investor to diversify. So gold historically has really low correlations to other financial assets. And we believe that investors around the world are noting that the benefit of gold and the need to increase the exposure to gold will be a structural change to the gold industry.
How can investors actually get exposure to gold? Obviously there's bullion and ETFs, there's gold miners as well. What's the difference between all those different ways to access gold? What do you typically recommend?
Sure. There's many ways to invest in gold. The most typical way will be through the physical gold. The consideration for physical gold is that you need to go to a store to buy it. Sometimes you need to pay a huge premium against the spot price, but the benefit is that you get to hold the gold and see the gold. Another way is to buy through gold-backed ETFs. Gold-backed ETFs trades like a stock. It tracks the gold price. It's very easy for investors to trade.
Probably a lot cheaper too.
A lot cheaper as well. But the implication or consideration is you need to do some research around the gold-backed ETFs because in Australia, for example, there's a couple that tracks the gold price. So investors need to study about the company and how they track the gold price. And lastly, probably quite common among Australian investors is the gold mining shares. Gold mining shares, it tracks the gold price, but it's very important to understand it doesn't track the gold price one-to-one. So normally the share price of the gold mining stocks will be impacted by the gold price, production costs, the way the management style in terms of acquisitions and corporate governance. So that's something investors need to take consideration of.
Okay, well, thank you so much for your time today, Robin. It was awesome to feature you on The Pitch.
Thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.